is to say, okay, that's fine. We can determine how much we need to get zero net income. That's called target net income. And again, it can be expressed in units or dollars. Now, when I think about target net income, I'm looking for the required sales, enough to cover my fixed costs and cover my my variable costs and cover my fixed, and give me a target net income. So there's my mathematical equation. What we do basically is required sales minus variable costs is the contribution margin, and we move the fixed costs over here, target net income plus fixed costs. So now to determine that level of sales, simply put, you add the target net income to the fixed costs and you divide by the contribution margin per unit if you want your answer in units, and that's 1,600 units. If I want it in dollars, I take the same thing, fixed cost plus the target net income, divide by 40,000, and I get required sales in dollars of 800,000. So to conclude, that's all we have to do is add the desired net income to our fixed costs and divide through by the contribution margin per unit if I want the answer in units, contribution margin ratio if I want the answer in sales dollars. So that's a tremendous benefit of using just the contribution margin technique. Now, a final concept here is called the margin of safety. That is the difference that a company is actually selling or expects to sell more than they need to sell in order to break even. That is, how many units more than they need to break even are they actually selling? Because if the economy declines, you see the number of units they're going to sell will decline. How far will they go before they hit the zero profit level? And that means it's a cushion. This idea is the idea of risk. It's this risk analysis. And basically, how far do sales have to drop before I am no longer in a profitable position? This is quite most often expressed as a ratio, but it can be expressed in actual dollars. So here we have an example. Actual sales, 750. What I need to sell to break even is 500. So my margin of safety in dollars is 250. So therefore my sales has to fall 250,000 so that if it does, then I'm at my break-even level of sales of 500. Most often it's expressed as a ratio though. And we do that by computing the margin of safety, 250, again, as a ratio, as a percentage of sales. So 250 divided by sales means that my sales have to drop by a third before I'm in a dangerous position. So the higher the dollars or percentage, the greater the safety. And managers look at this, financial people look at it and they compare the margin of safety in one company to the margin of safety in another, because you see, this gives them an idea of how risky an investment would be